Well, here we are, chapter 4. This is question 12a. Just doing a little bit of narrative and walk through to what's in the book. Hello. Well, here's a snippet of question 12a. We are provided the opening balance sheet, which is the closing as of March 31st, 2019, which if you notice, left side are assets, right side are the liabilities and equity, and you'll also hopefully notice that assets equal liabilities plus owner's equity at a balanced amount of $39,000. The other information we're provided are a chart of accounts, which indicates the account number for each one of them, for our reference, as well as the number of transactions for the month of April, which we are being asked to prepare journals for. After we prepare the journals, we will then post them, and we will prepare a trial balance at the end of April. So the first thing to do is to look at each of the transactions and go through them to determine what accounts will it affect. While you're looking at what accounts, would it be a debit or a credit? So you have to think, what account is that? If it's a cash account, you're increasing your cash. Your cash is an asset. To increase an asset, you need to debit it. So therefore, you would make the note of a DR standing for debit for that transaction. Once you've done this for each of the transactions noted in this question, you would then go and create the journal entries, which are noted on the right-hand side of the screen. So in this example, on April 1st, Thomas Topology purchased office equipment on account for $7,000. So now he has office equipment. So it's equipment and asset. You will debit the asset in order to increase the value of that equipment by $7,000, and you will credit the fact that he now owes, so therefore it's an accounts payable for the same $7,000. In this case, you can see it on screen that we've created that entry for April 1st. You'll also notice that we have a description where we indicate that he purchased furniture on account. Every time you're doing a journal entry, you always want to do the debit first, credit second, and then a brief description thereafter, just to remind you, the reader, management, whoever that may be, what you were trying to do at that time. April 2nd, you received $25,000 of all those cash for services provided. So again, you have cash in hand. Cash is an asset. You're increasing your assets. Therefore, it's a debit to your cash of $25,000 and a credit to service revenue. You're increasing your revenue for the same $25,000 for receiving cash on services. April 3rd, you paid $1,000 cash for April's rent. To increase your expense, your rent expense, you need to debit rent expense by $1,000. And you need to credit cash by $4,000 to indicate the fact that you used cash to pay that rent. Therefore, your cash balance is decreasing. And again, this is for paying rent for the current month of April. April 4th, you prepaid $1,200 for insurance for 1 year. So again, you're debiting prepaid insurance because it's for future periods of time, and you're crediting cash for the $1,200 that you paid out. Crediting cash because we used cash. You gave that cash away to the insurance company or the broker. And that's to prepay an annual insurance policy. April 10th, we paid $200 cash to reduce the balance of accounts payable. We will debit accounts payable by $200 to reduce the liability, to reduce the amount owing to our vendors. And you will credit cash for $200 to indicate that your cash balance has been reduced. And this is to record the payment to reduce accounts payable. April 14th, you paid $8,000 cash for employees' salaries. In this case, you're debiting your salaries expense and crediting cash for $8,000. You are now no longer in the possession of that cash. Your employees are. It's an expense of the organization. You've paid payroll for April 14th. April 22nd, you received a telephone bill for $250, which will be paid next month. So you will debit telephone expense because you're incurring expense for the organization, and you will credit accounts payable for $250 because you'll pay it later. So therefore you have a liability now as the organization for that telephone bill. April 24th, you recorded a travel expense for $8,000 to be paid next month. You will debit travel expense for $8,000 and credit accounts payable because you will pay it later So you're incurring a liability. To increase the liability, you will credit the accounts payable for $8,000 in order to record your travel expenses. April 30th, you paid $4,550 to the bank for the bank loan principal and interest. The interest was $50 and the remainder was principal. In this case, you actually have two components on the debit side. So you will debit your bank loan by $4,500. This is to reduce the liability, the amount owing to the bank for your loan. You will then debit the interest expense for the $50 as indicated, and you'll credit cash for the total amount of the payment to the bank of $4,550 because your cash balance did decrease, therefore it's a credit to the cash. And this is because you paid down loan principal and paid the interest owing on that transaction. One other column I will comment on is the PR column, the posting reference column. That references back to the chart of accounts. That is your chart of account number, your indicator for that expense account or liability, or any account, not just expense account, any account that you're posting to. It will come into play in short order. The next step can take quite some time, and I'll walk you through cash, and the intent is that it is repeated for the other accounts. So at this point, you will now go through your journal entries and you want to post them to the ledger accounts. The first one you see on screen here is the cash account, which is GL number 101, your chart of account number 101. In order to start any of your ledger transactions, the first item you want to put on is your opening balances. And remember, your opening balances for April 1st is the same as your closing balance as of March 31st. So I've included a copy of the balance sheet, which indicates our cash opening balance, otherwise closing as of March 31st, was $22,000, and because it was a normal balance, it is a debit. So we've indicated April 1st an opening balance for $22,000 as a debit balance. You would then look through each of your journal entries to determine what affects that cash account GL number 101. April 1st did not. April 2nd did. We debited cash for $25,000. So we'll record it on April 2nd. This was all done in one journal form, so it's J1 for this entire exercise. It was all done in one process. And it's a debit to the account for $25,000. So therefore, if we have a debit of 22 plus a debit of 25, we now have a debit balance of $47,000 in our cash. You will then carry on to the next transaction. April 3rd did affect cash. It credited cash for $1,000. So we'll record in the ledger, April 3rd, journal 1 still, a credit of $1,000. Therefore, if it's a credit against the debit, you're actually reducing the debit balance. So you have $47,000 debit less the $1,000 credit equals a $46,000 debit balance. You would continue that through each of the transactions. For April 4th, you had a credit to cash for $1,200. April 10th, the credit to cash for $200. April 14th, the credit to cash for $8,000. And April 30th, the credit to cash for $4,550. After each transaction, it's important to calculate what the balance is after each point. So you'll notice the balance is slowly reducing from $46,000 down to $32,050 by the end of the month of April. It's important to do this because there may be times where your account in your ledger may flip from, say, a normal balance of a debit to a credit. And then maybe later on in the month it flips back depending on future transactions. I will give you this hint on your assignments coming up. You do want to calculate each of those balances at each date because you might be asked on them. After completing cash, you will want to go through each of the transactions and complete the rest of your ledger accounts. So in the screenshot that's here, we've got accounts receivable B in the next account. It had an opening balance on the balance sheet of $9,000 debit. However, after looking at the various journal entries for the month, there were no entries that affected that account. So therefore, your closing balance is the same as the opening, and that is important to still do the ledger in order to feed your final trial balance for the end of the month of April. You would then move on. Prepaid insurance had an opening balance of $0. Had a transaction as of April 4th for a debit of $1,200, being the only one, therefore it has a balance of $1,200 as a debit. You would continue this through each account that's on your balance sheet or trial balance from the previous month, plus any new accounts that may have been triggered throughout the journal posting process. In this example on screen, we've got the equipment account, the accounts payable account, the unearned revenue, the bank loan, and the Edwards Capital. As we continue this process, we also have Edwards withdrawals, service revenue, insurance expense, interest expense, rent expense, salaries, telephones, and travel expense. You will notice some of the accounts do not have any transactions, but it's also a good habit to make sure you go through all the possible revenues, expenses, and other accounts that the organization may have. Once you've done this and made sure that you've posted all the journals to the relevant ledger accounts, you would just do one last review to make sure each of your ledger accounts have a closing balance that you can then do and bring forward in the next step. The last step in this exercise is to carry forward those ledger balance to the trial balance and check for the balance debit equals credit. In this case, we've actually been given the order per chart of accounts, where assets come first, then liabilities, equity, followed by revenue and expenses. So we've listed them here as per the trial balance in the ledger accounts, The cash balance, bringing that forward from $32,050, accounts receivable 9,000, etc. We would then, once we've included all of the accounts in our trial balance, total the debit column, total the credit column, and hope that you're in balance at this point. $74,550 on each side in this situation. If you are out of balance, I would suggest you check a couple of things. One is, did you bring forward the ledger balances correctly to the trial balance, or did you transpose a number? Did you put it in the wrong column, debit versus credit? If that was done right, then I would go through each journal entry to make sure you posted them properly within the ledger. There is a good chance you might have missed one of the sides of the entry, or did a miscalculation on one of your carry forward balances, etc. At the end of the day, in this situation, Thomas topology will have a trial balance where both debits and credits are equal at $74,550. I hope this walkthrough was helpful.